All right, everyone. Thank you so much for joining us again for another edition um, of our Franchise Your Business podcast and webinar series. My name's Tom Dufour. I'm the founder and CEO of Big Sky Franchise Team. And as everyone is loading in here to get the show on the road, just want to go over a couple housekeeping items before we get going. Number one, if you're new to us or you haven't been participated in this, we're going to go over a lot of information quickly, and we're going to go over macroeconomic data, and then we'll start digging into some more microeconomic data, starting and really drilling into small business and franchise specific information. Number two, if you have not subscribed to our podcast, we have two podcasts. The first is the Franchise Your Business podcast. That's where we actually replay this session. So if you miss it or want to share it, you can share it there. And we'll also upload this to our YouTube channel so you can watch that later. And then secondly is subscribe to our Multiply Your Success podcast. That's our top ranked podcast. Recently, we were ranked the number one podcast in franchising and a top 100 on Apple Podcasts in the entrepreneurship category. We have phenomenal guests on that. So if you have not subscribed and you like our content, we'd love for you to have that there. So as a quick recap for today, we're going to go over some quick hit items, and we're going to jump from one to the next to the next. My goal is to have you through this and out before in over the course of 30 the next 30 minutes. Um, excuse me, I'm getting over a cold, so I will try to mute when I have a cough. But to get things going, I'm going to go ahead and share my screen, and we'll get things going. If you do have questions, comments, concerns, feel free, type in the chat box, raise your hand. I can unmute you. Generally, we have a relatively low enough small enough number of folks that we can unmute this and you can ask your question midstream if that's important to you. So with that, I'm going to go ahead and share my screen and we'll get this show started. So here we go. Okay, so the first reports that I like to show is from the Institute for Supply Management, the Institute for Supply Management. And the first report here is their Manufacturing Purchasing Managers Index, the manufacturing PMI. It registered at 46.5%, as you can see on this chart. Now, the manufacturing, it reads here in this first paragraph, the U.S. manufacturing sector contracted for the seventh consecutive month in October as manufacturing PMI registered 46.5%. 0.7 percentage point lower compared to the 47.2% reported in September and August. This is the lowest reading since July of 2023. After breaking a 16-month streak of contraction by expanding in March, the manufacturing sector has contracted the last 7 months. So as you can see here, going back in 2022, it's above this 50% line. And the 50% line means that the manufacturing economy is generally at a break even. At the overall economy break-even line is at 42.5%. The reason I like to start with manufacturing is because it tends to be a leading indicator. And so what does that mean? Well, to me and for you, as you're starting to think about how this applies to your business, your franchisees, and folks coming through, is that as a leading indicator, this means purchasing managers are seeing that they're expecting sales to be lower than normal. It's going to be flat or less than. And so that's what it's saying. And manufacturing is important is because it has the most ripples out. $1 spent on manufacturing has the greatest contribution to the economy at large, between the suppliers and customers and all the other parts and pieces that go in together in manufacturing. That's why it's such an important, even though it's a small percentage of our overall U.S. economy, it's still a very important driver. And so this means that, in my opinion, this tends to be leading indicator. So maybe 12, 18, 24 months down the road is when we're going to start seeing these numbers impact in other facets of the economy. Okay, let's take a look at report number 2 that's put out by the Purchasing Managers Index. Actually, I'll click back here. This first report was prepared by Timothy R. Fiore, And then now we're on the second one for the Services Purchasing Managers Index Report, or Services PMI, analyzed and put together by Steve Miller. And the first paragraph reads, in October, the Services PMI registered 56%, a 1.1 percentage point increase compared to the September reading of 54.9%. This is the index's highest level since a figure of 56.4% in July of 2022. A reading above 50% indicates the services sector economy is generally expanding. Below 50% indicates that it is generally contracting. Excuse me. And then it says here, if you can see on this chart, if you're following online and watching, it shows that 49.0% equals the services overall economy break even line. It's the economy break even. Well, it looks like this is in here twice, 50% and 49%. Not sure what they mean by that. That may be an error. What you can take out of this is you can see dating back in 2022, there's a trend line you can pretty easily see up until about halfway through 2024 here, which is a steady decline in services. And now we're starting to see services surge. Services economy, the U.S. is mostly a services-driven economy right now. So this is indicative of a good indicator that we're seeing this positive trend in services, to see that growing. Again, $1 spent in services does not have the same multiple effect that manufacturing does, but nonetheless, it's still a very, very big driver. If you are in the services industry, what that means, what this is showing at 56%, same thing for franchising, is that it might be a little bit, from a sales perspective, might be a little bit easier to get a yes right now or this past month and leading into today. So that's something that you can take away from that. It might be a little bit easier to get a yes than it was just 3 or 4 months ago from a customer, or a prospective customer. Okay, let's take a look at the third report from the Purchasing Managers Index. This was a report, it's called the Hospital PMI. It's by Nancy Lemaster. And I'm going to start at the second paragraph in this report that Nancy prepared. It says the Hospital PMI registered 51.9% in October, a 3.1 percentage point decrease from the September reading of 55%, indicating a 14th consecutive month of growth. October's hospital PMI reading is the lowest since a contraction in August of 2023. So what I like to point out on this report, if you're looking at this visually, dating back to 2022, coming up through the end of 24 here, this is their newest report. And if you notice, it has the biggest swings, big ups and big downs. And my assessment on that, I have no data other than this is just my opinion on it, is that there may be some seasonality to hospital purchasing based on maybe the seasonal flu or cold weather or something, that virus that might be going around or something, with some of these big spikes that go up and down. Or it could be just the number of participants in the survey, as this is newer and they may not have enough participants yet for purchasing managers. Could be a combination, could be other factors, just sharing some ideas. So if you are in any health services related field where hospitals are buying stuff, stuff meaning just any kind of medical equipment, devices, supplies, and so on, you can see this zigzag. Good news is you see that it's still in positive territory, but pretty big swings up and down here in 2024. We'll see if this stabilizes or continue to rises. What I like to look at these three as broad economic indicators is if we go back to the purchasing managers, we see it's just below that manufacturing break even. We see services starting to pick up some steam, it looks like. If we look at that trend here, some pretty quick growth that it's going. Hospital PMI, we see it zigging and zagging, but generally it's above that number. And so for me, this has been a consistent theme for about 2 years now, where we're having mixed results, where we have some of these indicators that are just below and some that are just above. And to me, that's what this helps give some questions to the sentiment that I've been hearing from clients. Now, how does this apply to you in your franchise sales or your franchise marketing or preparing for expanding and talking to your prospects. Okay. The thing that oftentimes will come up as you're talking to candidates, they may very well start sharing with you and saying, "Well, I'm nervous about the economy," or we just had the presidential election happen, and some people say, "Well, I'm going to wait and see what happens post election." And generally, there may be a blip here or there for a week or two with the general economic conditions, but for the most part, government spending is doesn't change overnight in either direction, and it's really only gone one direction for decades, which is spending more. So regardless of whomever is in office, so when we look at that from an economic standpoint, it becomes less impactful. But some of your candidates might be saying, "Well, what's going on with the economy?" Or I might be a little nervous, or I'm a little unsure. Well, you can use these reports that I've been talking through as some supporting evidence to help give them answers where it's not just you saying, "Well, I think," or "I feel." You can say, "Well, it seems that things are growing, and here's this report, here's this data that helps give some information on that." Okay, so reference this, share this, and if you have franchisees in your system, you should be talking to them about this as well, and share that with them. That if you're in the services, we're seeing these services start to grow right now. That's a positive thing. Manufacturing, albeit has been low, but it's been pretty steady. It's been flat. So we're not declining drastically anymore, but we're steady. So steady is better than dropping. It'd be better if we were growing, but at least it's fairly steady the last couple of years. So to me, those are some foundations that you can start to look at and make some decisions for your business and be able to help talk to prospective franchise buyers. Okay, let's go back and share my screen, and we're going to go on to the next report. And this is from tradingeconomics.com. And I just like to look at the U.S. Unemployment rate. And you can see here that the unemployment rate for October was 4.1%. It was 4.1% for September, 4.2% in August, 4.3% in July. So we've seen throughout the year, the unemployment rate started in January at 3.7%, and it's kind of steadily rose. It peaked in July, and now it's kind of settling in around this 4%. So I think that's interesting. I don't know exactly what to make of that. Maybe there's some contraction. Maybe more people are coming into the workforce. So let's read what the Trading Economics had to say in their leading paragraph here. They say, the unemployment rate in the United States was 4.1% in October 2024, remaining unchanged from the 3-month low in the prior month and aligned with market expectations. The number of unemployed individuals was broadly unchanged at 7 million. So that means that the number of unemployed, again, was consistent. Among those without employment, permanent job losers rose slightly to 1.8 million, while temporary layoffs were little changed at 846,000. In turn, long-term unemployment was little changed from the previous month at 1.6 million. In the meantime, the labor force participation rate eased by 0.1 percentage points to 62.6%. Okay, so again, what can this mean? Well, when the unemployment rate is inching up a little bit, here's where this can be a favorable thing for your franchise prospects and for your franchisees. As the unemployment rate inches up, there's more available talent in the market, in talent in the talent pool that becomes available. That means people are actively seeking employment. So back at the first of the year, it was down at 3.7%. It's now up to 4.1%. Well, that means that as it's edged up, there's this a number of more. There are more folks that are looking at or that are looking for jobs. And as the unemployment rate starts to increase, the quality of folks that unfortunately end up needing to be either downsized or let go increases as companies have to make adjustments, which means that for your franchise candidates and your franchisees, it's hopefully means it's going to be a little bit easier for them to find potential new hires or additional hires for their company. Okay, let's take a look at the inflation rate. So this is from tradingeconomics.com, and they pull this data from the U.S. Bureau of Labor and Statistics, and it shows for October of 24 that the uh, uh, inflation rate was 2.6% compared to September at 2.4, August at 2.5, July at 2.9, June at 3%. Let me do the 1 year here. Um, and May at 3.3%. So you can see here, if we go back to January, we saw that it was rising and peaked in March of this year at 3.5%, and it's been this slow decline throughout the year with a little blip up here in October. But overall, you can see dating back in March, just a pretty consistent trend downward. We'll see what happens next month if we go back up, stay flat, or drop back down. But excuse me, nonetheless, this is a good sign for consumers and businesses just to see that inflation is going up. Now, the thing with inflation, just as a reminder, is this is a compounding effect. So if I zoom out 3 years, just as an example, this October 2.6%, if we go back to last year October, was 3.2% over the year before, which October of 22 was 7.7%, which was over the year before. So this is compounding year over year. So we're not talking about prices going down. It's just growing at a less robust pace. So I just like to provide that perspective, and that's why consumers and even businesses, why we're feeling a pinch where maybe that dollar just isn't going as far as it used to. And that's true. As a franchisor, ways for you to communicate this to your franchisees or prospective franchisees. Number one is you can see starting back here, June of 23, you start to see that inflation start to really level off around that 3% or 3% or so, a little up, little down zone. For about 2 years now, or no, I'm sorry, excuse me, a year and about a year and 3 months or 4 months now. So there's been some consistency there. So you can share that if they're concerned about inflation. And the thing that I've been saying for the last almost 4 years is if your franchise prospect is going to buy your franchise, if they're going to buy it, and you have that conversation and they say, I'm in, I want to buy your franchise. Every day they wait, it costs more. Every day they wait, their money is worth less. Every day they wait, the cost to buy the inventory, the products, the contractors, whatever it is they need to buy to run the business costs more. So the incentive is the reminder. It's not to use this as some manipulation tool. That's not the point. The point is to be genuine and sincere in communicating to your franchise prospects. By the way, Mr. or Mrs. Buyer, inflation continues to go up. Prices continue to go up. It is the reality. So if they say they're going to buy and they wait another 6 months, it's going to cost more. It's the value of the dollar is dropping. The cost of goods is rising. So they're getting it's a double squeeze there. So anyway, that is, in my opinion, is a conversation you want to have with the candidates as they're thinking about this, especially if you're in any kind of fixed location business, if you're in food service or retail or anything that has a fixed location. Prices are going up and it costs more to borrow. So I just like to iterate that point. Okay, let's move on to consumer sentiment. So this is from the surveys of consumers from the University of Michigan, and they've done this index of consumer sentiment for decades. And we can click on this PDF just to show what it looked like from the last 50 years. And you can see here in 2000, you see a big drop, and then 21, 22, a huge drop down. And now we've been on this steady rise up. You can see this trend line. I'll zoom in a little bit and arrow over if you're watching online. So you can see it bottomed out. I believe this valley here was the lowest number in 2022. I think that was the lowest in history. Could have been 1980 or 81 here that it was. It was either number one or two. but you see this steady increase here in consumer sentiment. So the idea, again, like I was talking about before with the services where it may be a little bit easier to sell something, this consumer sentiment, in my opinion, is indicating that it's probably a little bit easier to sell to consumers, that consumers are going to buy stuff today than it was 2 years ago or even a year ago. It's just been this steady increase in consumer sentiment. So to me, that's the pathway at which it's going to be, how easy it is or to get to a yes from a prospective buyer. And this also, by the way, you can apply this to franchise sales. It's probably going to be a little bit easier to get to that yes today than it was 2 years ago. So keep that perspective in mind. The objections might not, there may not be as many, or if there are as many, they may not be as intense as they were a couple of years ago. So keep that perspective in mind. And then if someone's on the fence or they're wondering about things, share with them some of this data. I try to include these links in the videos and podcasts here. So check the show notes and such, so you can access these links to reference and show and talk about. And just it's not your data. You're not making this up. And again, it's not manipulation. A more informed buyer or consumer, it makes for a better franchisee in your system so that they can understand this. And it communicates to your prospective franchisee as well, that you're looking out for their interest. If you're doing this in the sales cycle, you're likely going to be doing this for the franchisees as well. Okay, next report I like to take a look at here. This is the number of business applications from the U.S. Census Bureau. This is called Business Formation Statistics. And so this is for October of 2024. And it shows that there were a total of 424,656 new business formations that were created in the month of October. And what they do is they go to all the states and they aggregate all the states that had new business formation. So these are for all the people that are forming LLCs and S Corps and C Corps and so on within their state. These are all the new applications that are being filed. And it was down 0.4%, which is fairly minimal drop there. The data point that is just always, it just amazes me every single month. We've been doing this session here over 4 years now. And if you look dating back on this chart, if you're looking here, prior to 2020, from about 2018 through January of 2020, there were right around 300,000 new business formations every month across the country, right at or just below that number. Just looking at the chart. Then we see a dip when COVID hits, a huge spike, which I think that big spike might have been just when states and people weren't working and they were catching up on paperwork. And then it kind of, it yo-yos a little bit where it goes up and down and then back up. And then once it crossed that 400,000 again in 2021, the rest is history here for the last 3 years. You can see that more than 400,000 new business applications have been filed over the course of that time period. And for a while, I thought, well, are these companies that maybe were operating and they went out of business or filed bankruptcy and started a new company? There's no way that would be the case to have this many new businesses formed and started. So what I take out of this for you to be thinking about in your franchise for your franchise sales process is you must assume, as a franchise seller, you must assume that the person you're talking to about your franchise is going to start a business, and it's your franchise business, or maybe one of their own or something else. But you must assume that, because we've seen this. It's been over a 40% increase from that time period from pre-2020. And to me, the idea of entrepreneurship, self-employment, taking control of your own destiny is in the air. So communicating how your franchise helps that potential buyer, how it helps them get to where they want to be as an entrepreneur, as a self-employed individual, someone that's tired of wondering or worrying, are they going to have a job or not? Is their place going to be working or not? They're thinking about it. It's on their mind. So you have to assume that in the sales cycle. If you've tuned in before and heard me say that, I'm going to say it almost every session because it's such a big deal to me. You just have to assume that they're going to do that. And if they're going to start their own business, why not your franchise? Why not with you? Because especially for our clients that are emerging franchise brands, founders that are still involved, boy, they're going to get it straight from you, straight from the source. And you really care about helping them launch and grow and be successful in their endeavor. So make sure you're communicating that with them. Don't assume that they know that. Communicate that to them. They're going to need to know that. Okay, back to the screen to get us moving. We may run a few minutes late here. Okay. I went through this report last time, but this is from the U.S. Chamber of Commerce, presented by MetLife. They do a small business index report. They do it quarterly. This is the Q3 2024 report, and you can see it's at 71.2%. And this is just an index score from small businesses. And so what I like that it actually shows is that it's the highest number since Q4 of 2020. And you can see just this, it shows on the screen dating all the way back to Q4 of 2020 up to Q3 of 2024. So 4 years. And you can see just this slow, steady trend of a rise coming up to 71.2 to where we are today. And if we look at just the last 4 quarters, you can see here that we had this nice steady rise the last year. And to me, again, that's positive. That means small business owners are feeling more confident about things, which means that your franchisees are likely feeling more confident about things, and that you can communicate that confidence and share with prospective budding buyers that other small businesses are feeling better and seeing a better outlook today than they were even a year ago and a year before that, and so on. So anyway, just to share that. Next, let's take a look at some reports from Franchise Insights. Where is that report? Give me 1 second. Let me just pull up the report that I wanted to share. Thought I had that up here. It's from Franchise Insights. It's their small business startup sentiment index. Here we go. Okay, this is what I was looking for. I thought I had that up. All right, here we are. Okay, back to sharing. So this is the Small Business Startup Sentiment Index presented and compiled by Franchise Ventures. And I love this report. This is from a survey that was conducted October 24th through the 31st of 2024. I mean, this data is as fresh as it can be, okay? And I love this headline here. Startup sentiment, 75% say now is a good time to start their business. And this other headline right at the top, aspiring business owners see clear skies ahead. Record 92% plan their startup launches within 12 months and 77% within 6 months. So let's dig a little bit into it. All right, I love this. They ask the respondents, is now a good time to start up the business? And 75% of them agree or strongly agree that now is a good time. And what I really like to see is this strongly agree number is 38.7%. It's the highest reading since back in May of 2022. I mean, it's been two and a half years since it was that high. So I think that's really, really favorable. So just a big, big jump in that. What does that mean? That means people are excited about starting a business right now, And I'm not terribly surprised because we're at the end of the year. People are motivated. They've maybe had a goal or a to-do list item of starting this business, and here we are in the fourth quarter already. So don't assume just because it's the end of the year that people are just going to sit there and get through Thanksgiving and Christmas and New Year's and then start doing this. Don't assume that. Don't make the decision for the buyer. You need to assume this report literally is saying 75% of prospects say right now, not tomorrow, not in 3 months, not in 6 months. Right now is a really good time for startup. They may not tell you that, but you need to be aware of it. Okay. Let's take a look at this. A record 92% expect their startups within 12 months. So 31% of people said that they are expecting to start their business next month. 24% are saying in the next 2 to 3 months. 22.7% are saying within the next 4 to 7 months. So if we look and do some quick math here, about 54% are saying between now and the next 3 months, 2 to 3 months. So between now and basically right around the end of the year or January, are looking to start their business. Like we said, right now. So when you're talking to candidates, be thinking about how you can communicate, how they can get started now, how they can get accelerated now, how they can, if they get started now, they can get a jump on the first of the year or start their site selection. Or if you're in a service-based business, maybe they can be operational in Q1 if they were to sign up today and get things going. Okay. I always like this report here. It says, which of these factors will have the biggest impact in the next 6 months on your decision to start a business? Well, 2/3 of them, 66.7%, said funding or access to credit. It's by far the number one category. It's been consistent pretty much every single month this report gets run. Funding and access to credit's the number one. So if you do anything to support your franchise buyers in the process, figure out a way to get funding. If you need a list of referrals, we've got great franchise lenders that we refer out that specialize in franchise funding. Most of them are brokers, but they've been in franchising for a long time and they know how to do this. If you can self-fund franchisees, if you can figure out some other alternative ways to support the funding for them, having some solutions is going to help your franchise prospect through that. Number two category is the economic climate, 41.3%. That's the number two category. So watching a program like this, sharing it, having access to the links, if you can communicate this, share this with someone, or share this recording with them. If you don't want to go through it, just share this recording with them. It can help calm their nerves to share what is actually going on so that they can see a bunch of different data and try to make sense of what's going on. And then the third largest category is political changes at 24%. But you can see here, funding and access to credit by far the number one, economic climate by far number two. Everything thereafter really just starts to trail off. So those are the big two. So figure out a funding solution if you can do that. And two, use sources like this webinar series and others to help educate. Okay. That's it for this report. Okay. Next up, I want to take a look at franchise development prospects were asked to share their perceived strengths. So if you're getting leads from some of these franchise lead gen sites, what are people saying? Well, I found this interesting. Okay. So these are the top 3 self-reported strengths by people. Willingness to follow a proven system. 56.7% of people said, I'm willing to follow a proven system, which is great. That's what we want in successful franchisees. Grit, persistence towards a goal despite obstacles. 53.2%. Awesome. People are going to follow system and stick with it, persist, right? Those are really great characteristics. The number 3 is team leadership experience at 39.8%, supportive spouse or partner, 35.1%, access to sufficient startup capital, 33.3%. So I find it interesting if we do the math. I don't know if there's any causation or correlation here, but just to show that access to startup sufficient capital, 33.3% said that that's a strength of theirs. And in the previous chart, we showed that 66.7%, the other 2/3, said that that's their number one concern. See how those are measuring up there. Experience in the business segment on pursuing, 28.1%, and then prior business ownership at 24%. Okay, so I think this is just worth noting that prospects coming in, most of them are thinking, I've got to follow a system and I've got to stick with it, which is what 2 very important categories. All right, now we can take a look at this chart here that shows biggest gainers and in terms of percentage change in share of franchise interest from Q3 of 23 to Q3 of 2024. Red means they're lost interest. and the brighter green it is means it gained interest. So you can see California was the brightest red, Texas was the brightest green. We've got the Carolinas, Georgia, Missouri, Pennsylvania, Utah, Washington in this red color. And then we can see some of these brighter greens like Illinois, New Jersey, Massachusetts, and Tennessee as some brighter green states to be taking a look at, and look at the states that are growing or not. This report that was put together by Franchise Insights and Michael Alston did note that some of the interest or waning interest in some of the Carolinas, for example, likely were impacted or likely was impacted from the hurricane damage that went through. Okay, we talked about that. We talked about that. Oh, final chart is just showing the top categories in franchising. Now, this is their business opportunities segment, but I'm pretty sure they switched these. I figured that out about a year ago. So this shows that of all the inquiries that come in through Franchise Ventures, which is the largest collection of franchise leads in the country, they show that home service brands account for 24.8% of leads. A business service, if you're in the business services, 14.3% of leads. Senior and health, 13%. Food and restaurant, 11.4. Cleaning and maintenance, 18.4. Pet services, 6.4. Child related, 3.6%. Retail, 3.4%. Education, 2%. And financial services, 2%. So what does this mean? Well, if you're in the top 10 categories here, if your business falls into one of these top 10 categories, chances are it's going to be easier for you to find leads. That's all this is saying. If you're in a top 5 categories, it's going to be much easier than the 5 categories below. And really, especially these top 4, because each of them are over 10% of interest of the category share. So that is my presentation for today. I'd love to thank you all for being here and open up for Q&A while we have some folks on the line. I know I ran a little long here. Thanks for sticking with me today. So any questions, I'd like to open up to the group here. Well, I'm seeing people fall off and no questions come in. Oh, wait, we've got one here. Let's see. When working with franchisees as franchise sales as franchisor to help calculate ROI from their initial investment to begin, do they need to figure the down payment on purchasing land and a building as an asset versus leasing for a cash on cash ROI? Okay, so the question here, okay, this is a pretty detailed question, is asking, do you help franchisees calculate their return on investment for the franchise? Generally speaking, you want the franchisees to do their own math on this. So you may need that they need to run their own numbers and build out their own business plan. If if the franchisee is already bought into the business and you're working with them on completing this their business plan, just as an example, and you're helping them calculate their ROI, I like to look at a cash on cash return on investment, which I think is what you're asking there. So I view the down payment as a cash payout that they're going to need. So if they get a loan, they're for building for the land and the building and whatever else might be coming in, they generally you're looking at roughly 30%, a third down for the total price or the total loan that they're going to have. So I look at a cash on cash return when I take a look at that. You can look at a cumulative return for what they're looking at, but I like the cash on cash return, especially with a big loan, because I want to see how I want to be able to show them how their cash, the difference between the return on cash that they can have in their business versus other alternatives for them to see. So if they're able to see, as you put in here, a minimum of 15% cash on cash return over a couple years, that's generally going to outperform most other investments that they would have. And they're taking control of it they'll have greater control over the performance because they're going to own it. If they're an owner operator, they're going to work in the business. So they're going to have more opportunity to make an impact in that regard. If it's a prospective buyer, I would double check with your attorney on what they're comfortable with you sharing. But generally speaking, you should not be talking about a return on their investment they should be figuring out those numbers and using whatever's provided in your franchise disclosure document. So that has changed a bit from my understanding over the years, but yeah, I hope that answers that question there, Eric. Thank you. Good, very, very good question. Other questions that have come through here, or anything else? All right. Well, as always, I'd like to thank everyone for tuning in. Please subscribe to our YouTube channel, Big Sky Franchise Team, and our podcast, Multiply Your Success. Thanks for being here this week. Have a happy Thanksgiving. It's my favorite holiday. I hope you enjoy it and have a safe and fun holiday with your friends and family and loved ones. Thank you so much, everyone. Take care.